QuickBooks Pro Desktop 2021 Loan Manager. Enter loan where payments have already been made. In other words, we want to set up the amortization table in the Loan Manager, but we've already made a few payments. How do we set it up in the Loan Manager to start at the point where we need it to start at? Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Loan Manager practice file. We currently have the open windows open. You can open the open windows by going to the View dropdown, selecting the open windows list. We now want to think about a loan situation where we're setting up the Loan Manager being found in the banking section, to the Loan Manager for a loan that already has a few payments on it. So we're not on payment number 1, we're somewhere inside the loan. Let's set up the loan first. This is the typical process. You have to have the loan on the books, and then you can add it basically to the Loan Manager. So I'm going to go to the Reports drop down. I'm going to go to the Company and Financial. Let's take a look at the Balance Sheet Standard. We'll also add a second loan so we can see what it will look like in the Loan Manager when we have a couple different loans that we are running. And then I'm going to change the dates up top from 01/01/20 to 12/31/20 and say OK. And so we have our information here. We have a loan. This is the first loan that we were running. Let's now say that we're going to put a second loan on the books. And this is the amortization table. We won't build the amortization table this time, but it's going to be a $30,000 loan. And I'll put it in there for the period beginning on 1/1. But then we're going to imagine that we're not going to put it into the Loan Manager until some later points. Possibly we'll put it down here on the 4th payment here. So I'm going to say it's going to go into the Loan Manager, say down here. So I'll put it on the books as if we would normally put it on the books. Then we'll record some normal payments with just checks as we would do without the Loan Manager, and then we'll enter in the Loan Manager at payment number 4, and then pushing forward from that point. So let's put it on the books. It's going to have cash. I'm going to assume we received cash for the loan, so I can then go to the Lists drop-down, Chart of Accounts. I'm going to add up the checking account, and then I'm going to say on 1/1/20. Let's do this on 01/01/20. Hold on a sec. 01/01/20. This is going to be, I'm going to call it, it's going to be a deposit. Now I need to set up a vendor here, the bank, and make sure that you set it up as a vendor. So this is going to be bank, and I'm going to call it bank number 2 just to differentiate it. And when I set it up, I'm going to say quick setup. You might be tempted to put other like I did last time, but if you're going to use the bill function, if you're writing checks, not a problem, but if you're going to use the bill function, you need to set them up as a vendor. So set them up as a vendor here, and then I'm going to say OK, and then we're going to say the deposits for the $30,000, and then we're going to say the other side is going to go to a new loan account. I'm going to call it loan payable, and then I'm going to imagine I have the last 4 digits of the loan number. So loan, get rid of that capital O, loan payable, and then I'm going to say last 4 digits of the number, the loan number or something like that to differentiate the loans. I'm going to set that account up. So I'm going to go ahead and say set that up, please. It's going to be a liability type account. So I want it to be an other current liability type of account. And it's going to be, this is the name. I'm going to put it under the subcategory of loan payable. So we have loan payable, and then these 2 loans underneath it. These are the particular loans. I'm going to say save and close then. And then we got to make sure to record this down below and OK. And then I'm going to close up the register. I'm going to close up the chart of accounts, go back to the balance sheet. Now we have the second loan here on the books at the $30,000 for it. Now let's record the first couple payments, first like 3 payments just with normal checks, and imagine that we got this amortization table basically from the bank or allowed the our CPA firm to build it from this information up top. For example, the loan amount, $30,000, periods are going to be 3 years. And we pay monthly. 3 times 12 is going to be that 36. Interest rate 8%. Therefore, the payment's going to be $940.09 about. And then we have our payments that are going to be down below. Same amortization kind of layout we saw with the prior loan. I'm going to be paying these off one at a time. We're going to start with this one. Let's pay this one off. And then I'm going to go to my QuickBooks, and I'm just going to write a couple checks. And let's just write them pretty quickly here. And I'm going to say this is what we would have to do without the Loan Manager. I'd have to physically, write the check, Same thing if it was an electronic transfer, a decrease to the checking account, and if it was coming through bank feeds, I would have to stop and make sure the bank feed input was done properly to hitting the right two accounts for the right amounts. So this is going to be as of 01/31/20, and this is going to be for bank 2 that we are now paying. The amount is going to be for the 94009. So this is going to be 940.09. And then the account down here, we got the loan payable. I'm going to say for the second one. Is this the second one? Yeah, that's the one we just set up. And that's going to be for the amount of, and I'm going to pick the loan's going to decrease by the 740.09. So I'm going to say this is 740.09. And the other side would be, note that it should be going to interest expense. We're going to put it to insurance expense, miskeying the account, and then we'll fix that at a later point in time. So you can either put interest expense now, which is the proper account, or you can follow along and fix it with us in a future point on this presentation. To interest expense for the 200, which that should match out here, the 200, that looks good. I'm just going to record the 3 payments here in succession, then we'll take a look at them on the balance sheet. So I'm going to say save and new, and we'll do it again. So save and new, and I'm going to say now, this is on 02/28/29, because there's 29 days in 2020 apparently. And this is going to be for bank number 2. And then it memorizes our kind of accounts down here. So now I just fill in the numbers. And so I'm going to say this is the green one now. It's the last green one. That's the one we're doing, the last green one. So it's going to be the amount then of the 940.09. 940.09. 940.09. Tab, tab, tab. And then we need the loan is 745.02. So this should be 745.02. Tab, 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 tab. And then this is going to be the 195.07. So this is 195.07. Tab. And then let's do it one more time. So that's going to be, notice of course this is a different breakout. And that's going to be kind of our issue oftentimes with these loans. These breakout between interest and principal keeps changing on us, which is annoying. And then I'm going to say save and new, and we'll do this again. And this one's on 03/31/20, and this is for bank numero 2, numero dos. And then we'll say this is the 3rd payment now. And this is going to be for the 940.09 once again. So 940.09. And then the loan amount, we have to change it again because this time it's 749.99. So it's 749.99. And then the interest amount is going to be the 190.10. So this is the 190.10. And then I'm going to save and close this one, and then we'll take a look at our financials. So I'm going to say save and close. Yes. Back to the balance sheet. Back to the balance sheet. And then we're going to take a look at our loan here. So if I double click on the loan, then we have our payments, the 3 payments that would be made. This is kind of what we would expect it to be laid out to and look like. And so we've got our 3 payments. The amounts that are decreasing the loan balance differ each time because there's a difference breakout between the payments. So I've got, if I go to the first one, the balance 29,259.91. After that first one, 29,259.51, and then after the second payment, we're at 28,514.89. So that would be this one, 28,514.89, and then 27,765.89. 27,765.89. That's where we're at this point in time. So we're at this point. I'm going to ungreen these. I'm going to ungreenify these, right-clicking them, ungreenify. And now we're at this, we're basically, we've entered these 3 transactions. So we're basically at this point. Let's actually greenify this one. We'll greenify this one. That's where we're at. And this is the next payment that we're going to make. So now I want to enter this into the system after those 3 payments have been now entered to put us at this point on the amortization table. So it's pretty straightforward to do that. We go to the loan manager, banking drop down, loan manager, and then we're going to set up another loan. So we've got one loan here. We're going to set up another one. Going to add a loan. And now this adding a loan, remember, doesn't change anything on the financials. It's just adding detail. It's giving us information about the loan, giving us basically the amortization table for it. So this is going to be the loan payable. This one, the second item, there's the balance that's currently on the books. The lender, I'm going to say, is Bank 2. Make sure that's a vendor if you want to be able to create bills. If it's a check, it could be other, no problem. Original date is going to be 01/01/20 once again. The original amount was $30,000. And then the term in months, because we pay monthly. It's a 3-year loan, but we pay monthly. Therefore, 3 times 12 is going to be, that's what we set up, right? It's going to be the 36. So it's 36. And monthly, as opposed to the other options we do have, but monthly would be the most common. And so I'm going to say next, and then the due date of the next payment. So and notice this is where we're going to kind of change things up because I'm on payment number 3 here rather than payment number 1. So the due date of the next payment we're going to say is on 4. We made 3 payments. We're on payment number 4 actually. The next payment is 4/30. So I'm going to say 04/30/20, and this should actually be 4 because we're on payment number 4. And then the payment amount that we need to be paying is going to be that 94009. So 940.09. It's going to be paid monthly, and does no escrow involved. Remind us 10 days before. That's fine. Total payment $940. Okay, next. So now the rate we said was 8%. So that's given us in the data up top. So we're going to say rate is at 8%. We pay it monthly. The payment account's coming out of the checking account. And then the interest is going to be interest expense. Interest, not insurance. Interest. I hope I did the last one, not to insurance. I've done that before, going to insurance. Not good. But then we're going to say finish. There we have it. So now we have the new loan set up, and if I go to the second item then, and I did mess up on the insurance expense, so we'll fix the insurance expense thing, but hold on a sec. We're going to go then to the payment schedule, and now we have the payment schedule. Now it starts here right on number 4, like it should. So it started on number 4. The amount at this point in time is $27,764. That should tie up to the $27,764.89 here, and everything lines up. The next payment that we're then going to be making is the $754.99 for the principal amount. And that should tie out to here. $754.99 is the next payment. So if I was to make the next payment, this is where we're at right now. And now I'm going to ungreenify this. The next one we would then do is this one. And once we make the payment, then we'll be at this point. So now let's make a payment. And let's do our bill payment type again so we can kind of sort these. And again, you can kind of generate all these and then sort them in your payables, which could be a nice way to do this. So we could then say I want to set up a payment, and this payment is is payment number 4. The principal $754, the interest $185. So that looks good. That looks good. I'm going to write it to a bill, and then I'm going to say okay. It generates the bill because we had a vendor, so it makes a bill of it. And the date on this is going to be 04/30/20. Due date 04/30/20. And there we have it. So I'm going to say save and close on that one. Yes. Okay, and then if I go back to the balance sheet, now I had entered the wrong side I entered it to insurance expense on the other 3 payments. So if I double click on this, on these 3 payments, so here's payment number 4 that we made with the loan processor with a bill instead of a check. On these 3 payments, I'm going to double click on them, and I went to insurance expense. I did that. So now I'm going to go to interest. I'm just going to change those. Interest expense. And then this one should be interest expense. Interest. And then save and close. And then the last one I'll make to interest expense. So this is going to be interest expense. Save and close. And so there we have that process. So you can set it up. You can set up the loan even if you're in the middle of the loan, right? You could set up the loan and just line it up to wherever you are at the current balance that is due. If you don't have a full amortization table, you can make one, or you could have just the balance that is currently outstanding, and hopefully when you put this thing into the system, it'll generate the amortization table to match where you are at that current point in time.